Yes, Naren joins us now. He's Executive Director and CIO with ICICI Prudential AMC. Naren, good morning. Thank you for joining us.
Good morning.
Exactly a year ago, there was fear, there was no excitement, and there was low participation. Now there is perhaps concerns are getting addressed, FIs are back, and in terms of fear, the fear has evaporated. What do you make of the current market setup? I'm speaking your terminology, Naren, learned it from you, fear and greed.
I think we are in the middle. That's the challenge that you don't have a situation where I don't think we are in greed. If you have greed, you will have huge local mutual fund inflow. If you look at the mutual fund inflow data in April, it was one of the lowest in recent times. And if you look at most of the new fund offers, the new fund offer collections are also not very high. So we are not in greed situation like what we had in 2021. So we are neither in greed nor we are in fear. So we are somewhere in between. So we are in a moderate return environment is what we think at this point of time. So we don't need to be at two extremes always. We can be somewhere in between also, isn't it?
On the macro picture, Naren, what is your take? Worst of inflation is behind us. Would you agree that? And if that is true, what does that mean for equity and bond market?
I think the macro picture is fantastic. If you ignore anything that can happen in future, because if you look at the current account, for example, which is one of our most important indicators, we used to fear about current account last year in this phase, and the trade deficit, which we look at not just goods, we look at goods and services put together. That number was looking pretty negative, and over the last 3-4 months, if we look at trade plus services, that number looks much more comfortable. That we have ceased to worry about current accounts. So that's one thing which is gone. If you look at inflation, I would say that inflation worries are lower, but in the way inflation index is constructed, we have to keep in mind that we are talking of just ahead of monsoons, and people are scaring us on account of El Nino and things like that. So that we have to little bit worry about monsoons, and therefore, but at this point of time, oil is the other product we always worry about: oil, coal, fertilizer. I think that basket, I think the worry has kind of disappeared. So I would say that, in fact, OPEC is forced to cut production to maintain prices. So which means that we don't need to worry about it. So I would say that that is a worry which is lower. I think the superb steps taken by the government in terms of improving the digital footprint to improve compliance in direct tax, the kind of GST collections that we are getting at this point of time, all those things are certainly helping tax collections. That I would say that the fiscal situation is reasonable. So on the whole, I would say the macro is the biggest positive at this point of time, and I would say that unlike other countries which overdid the fiscal and monetary bit in 2020-21, we did not, and that's why we don't have the inflation problems that the Western world is staring at it over the last 1 year. That's why the macro is not the problem at this point of time.
Okay. Naren, in the overall scheme of things, how much importance would you give to the election cycle? Today we are acknowledging it, but 6 months from now, markets will be talking about it. Naren, are you there? Okay, is he ready? Can I go to him? Up, zoom out. Okay, there's a bit of a camera problem. Sometimes it happens when you're doing live television, just pure compulsions of, live television, so to speak. Can I go to Naren? Is he ready?
But it's interesting, Nikunj, because he's talking a lot about how, the macros as of now are looking fairly resilient, and there is uncertainty on the inflation front, Nikunj, when it comes to monsoon as well as El Nino, but otherwise, that's moderated.
Naren, in the overall scheme of things, what to your mind will be the importance of the election cycle? Simply because today some we are acknowledging it, 6 months from now few will start talking about it, and in May 2024 everyone will talk about it.
Preparing for this meeting, I was just thinking, if you look at 2003, 4, 2008, 9, 2013, 14, 2018, 19, you had a situation where all the years you had volatility. And what that means is clearly, funds which benefit out of volatility, like hybrid funds, will definitely benefit because you have seen volatility in all the election years. And there is absolutely clear that volatility is given in election years. If you go back and look at 2003, 2003 markets were dirt cheap. And 2003 kind of market we are not seeing at this point of time because market is no longer as cheap as they were in 2003. They are much, much more overvalued compared to 2003. To factor in 2003-4 is impossible. So I would say we have to, when you think of the election cycle, we have to believe that we are going to have some amount of volatility in the next 12 to 18 months. And that is why for us, both systematic investment plans and hybrid investing for lump sum, which is categories like aggressive hybrid equity and debt, balanced advantage, multi-asset, equity savings. These are all the ways to go for the next 12 to 18 months, along with systematic investment plans and systematic transfer plans. Because volatility is not going to go away in the next 12 to 18 months, both for global reasons due to the Federal Reserve and due to local reasons because of higher valuations. And that is how we think when we looked at where we are today.
Naren, as per the last disclosure data, if you look at your funds and if you look at the disclosure data of some fintech and consumer tech companies, ICICI Prudential AMC has been a buyer in them. You avoided this sector for 2022, but do you think right now the setting on the table is attractive to buy into some of these consumer tech and fintech companies?
Basically, in our principles, as you know, we are contrarians, and when we find that companies are getting more attractive on valuations, and many of these companies have done extremely badly in the last 1 year, as you know. And most of those holders which were holding, they actually have been getting out of them in a very, very big way. So we saw an opportunity to look at those stocks as they fell. And they have been the worst performing stocks in the Indian market. And we are not opposed to looking at anything as long as we feel that the embedded value in them becomes more attractive. And that is the framework which we use for investing. And, many of our older sectors which we were which we liked a lot, many of them have done extremely well. With our open approach to investing, we thought, why not consider them? But if you look at as a percentage of our assets under management, they are negligible. So while the market talks about our investing in them, if you look at the absolute percentages of our corpus, they are very, very small. But yes, we are willing to look at them. We will, if many of the new companies also come in them, which are more, they come at much more cheaper valuations. I don't see why we should not look at them if they come at reasonable valuations.
Say IT services, is it worth a contra thought now? Is it looking attractive enough? Is it like buying banks in 2021 when nobody liked them?
It is certainly a contra thought, but if you look at it, it is just one or two companies which have really crapped out, and they are certainly worth a contra thought. And we need to understand why those companies did so badly. Normally in a sector, what we have from our experience, small and mid caps will do much worse than the large caps. But this time we have had a situation where some of the large caps have done very badly and some of the small and mid caps have delivered good numbers. This is something which is surprising to us at this point of time. but it is something which we are focused on. And on top of it, you have disruption worries like Chat GPT, what it will do to the sector, etc., etc. So we have to look at that part. But if we did not have the disruption worries, I would say already they have come to an attractive level. So barring the disruption worries, I would say that they have already buying price worthy relative to the market. So we are doing the work at this point.
Then you bought a lot into NTPC, Power Grid, utilities, and that was like a very, very boring call when you started buying into it. Why is ICICI Prudential and why is S. Naren and his team buying into some of these stocks which essentially have been the dogs of the market? Now, guess what? That call has worked like a charm. Is the best of the gain in some of the power utilities, power generators, power producers behind us?
See, the reality I'll tell you is power is a long cyclical. Power, real estate, these are all long cyclical. They are not going to go down suddenly one day. If you look at power demand, it's going to shoot up in the next 3 to 5 years. People talk of China plus one, Europe plus one, data centers, everything. Everything requires power. So power demand is going to shoot up in the next 3 to 5 years. So the demand for power is going to keep on going up with electric vehicles and everything going up. So I don't think power as a sector is going to do extremely well. Now, at what price point do these sectors look overvalued? And some of these companies have done the brilliant step of moving into renewable and building very, very good renewable footprint, improving their ESG footprint, focusing on the renewable area in a very, very big way. And along with that, I would say that both the governments have also improved by focusing on the DISCOM financial situation has also been improving. So you have multiple positives which are happening in the sector. So, we really do not have to worry about it. But the reality is it the time to increase weightage in these sectors for someone like us who have hitherto been very, very bullish? The answer is no. But is it the time to get off the street? I don't think so, because power is something very basic, and where even electric vehicle means that demand is going to go from oil to power, and all these companies are going to set up a huge solar and wind and renewable footprint in the next 5 years. So I don't see any worries.
So, Naren, what is cheap? Where do you think right now there is fear and markets are mispricing future growth?
Actually, this is where the debate is. We are in the middle. And, it is boring to say we are in the middle because, if you really thought that it is very nice to be in extremes. And, when you are in extremes, like, you can actually make bets on either side and take a very, very big bet. But today we don't have those extremes. And we have to recognize that we are not in those extremes. And so, last year, 6 months back, there was extremes in global markets. Global markets had turned extremely cheap. So after that, India underperformed a lot, and that extreme also got removed. So I would say that today we are not seeing any big extremes. And consequently, what is relevant at this point of time, which is that we are in a moderate return market. And I would say that a moderate return market with some amount of volatility in the next 18 months. And India is one of the best structural stories in town, given that we are geopolitically in the middle. And that is where we are at this point of time. And we can't identify areas at this point of time where we can see extreme greed. We can't identify areas where we can see extreme fear at this point of time. And that is a reality. We have had good periods where quality has done very badly. We have had periods where value has done extremely well, which is well reflected in some of the funds. So we have to be in the middle at this point of time, and it's okay to be in the middle. One doesn't need to always be in extremes. And this is the learning. And you can see that, some of the auto stocks which people believe will never do well have come out with outstanding numbers at this point of time. And, very many of the PSUs, which, people used to criticize, have all done extremely well in the last 3 years. So this is not the time to go and say that, every time you have to be contrarian. But we are more open today to look at quality. We are more open today to look at some of the new age companies. We are looking at sectors which have done badly, like technology and pharma, with an open mind, and see where we can actually increase weightages at this point of time. But we are not in extremes.
So if you're right in the middle, what will happen to returns then? Like single digit returns? Because it's only in extreme the returns they change.
Exactly, it's very tough to give these numbers, but instead of saying single digit returns, we actually say moderate returns. What does moderate return stand for? Does it stand for high single digit? Does it stand for low double digit? These are all questions that you can decide yourself, and that is how I feel more comfortable using the word moderate, because moderate can stand for anything at this point of time. And so moderate returns with a bit of volatility is what I believe in saying at this point of time. But I can't see 20% return at this point of time in the markets at this point of time. Neither can I see minus 20% given India's macro, unless something were to happen, an event which I cannot factor and believe in at this point of time. So neither extremes do I believe in at this point of time. Last year at this point of time, there was so much worry on Ukraine, Russia war, oil, current account, etc. Those kind of worries don't exist at this point.
Financials is the most overweight allocation for most of the mutual funds. Everybody is happy with what banks have reported. Credit growth is decent, NPAs are low. But if that is the consensus view and that is the consensus positioning, why do your funds also have a market weight to marginally overweight exposure to financials? I mean, that's not your style. You have to be contra. And financials right now is a consensus call.
Look at the numbers that have been delivered by all the banks. They are very, very good. And if you look at it, if the only reason banks haven't done well is because the flows have not been very high. Even today, if you get $10 billion from FIIs, I'm sure $4 billion to $3 billion will go into financials. And that is the challenge at this point of time, is that the flows have not been very large. If the flows had been larger, I can assure you that you will have a situation where financials would have done well. Again, I can tell you, if you're going to have $10 billion of outflow or even local outflows in a big way, financials will do badly, not because of fundamentals, but because of the fact that you have a situation where people will have to sell financials. See, I do agree that you're not going to see a situation where credit growth, net interest margin and NPL, that entire combination will be as good as where it is today. But normally at that point of time, you'll see record valuation that we are not seeing. So that's why we are in this more neutralish view. While we do believe that the cycle of NIM, NPL and credit growth is good, valuations are not at record at this point of time. Valuations are more reasonable. In fact, there is a prominent broker who is known for giving bearish presentations. He has been saying that this is the only sector which is more reasonable in valuation. And he's a person who loves to give sell calls on many sectors on the basis of valuations.
Broker, Naren, who's giving bearish calls on financials? I want to know the name.
No, there's no one who's giving bearish call on financials because it's the most reasonable sector on valuations at this point of time.
Saying there is a broker who gives bearish calls, he's also bullish on financials.
Yes.
So who's this broker who gives bearish calls? Let me rephrase my question. Okay. Naren, last question. Last 12 to 18 months, we've seen an uptick in inflation. Growth stocks have come down because interest rates have gone higher. Now the reverse should happen. Interest rates will not go higher. If at all directionally, they should have a natural decline. What will happen to growth stocks and what will happen to value stocks?
What people forget is that There was a period of time when interest rates were zero. When interest rates were zero, there was only one game in town called growth stocks. If you do believe that in US interest rates are going to go back to zero, again the only game in town is growth stocks. You have to, what people tend to forget is that interest rates in US is no longer zero. Interest rates in US is 5. Now, the only thing people are saying is interest rates will stop going up. They will not go up from here. But no one is saying interest rates go back to zero at this point of time. So I think the world is more balanced in terms of growth, quality, and value at this point of time. And I'm not a believer that like last 3 years or 2.5 years that value alone will do well and growth will do badly. But it's more balanced. If you believe that interest rates will go back to zero, I think it's going back to growth only. So I think now we have to do stock picking across growth, quality, and value. And we have to do the right things. That is why today, if you look at the market, there are, for example, a value stock in the auto space has done well, a growth stock in retailing has gone down, and a quality stock in pharma has gone down, if you take today as an example. So I think we have to do stock picking across the sectors, and it is going to be more balanced. And the job for a person like me is to find contrarian ideas in growth, value, and quality, and not say I'll do only value. Then I think I'll become obsolete in very quick time.
Naren, next time we'll have a discussion on AI and what kind of stock, spotting AI is actually doing right now. But today, everybody in my studio is saying that it's a moment in history. We made S. Naren really smile and laugh on air. Last time, I guess you smiled this much was when you got your call on Bharti, right?
Many calls have gone right, luckily. So that is the positive. And, the mutual fund industry has also grown a lot over many years, thanks to the support of media like you also. So that's the real thing, actually.
So now you made me smile when you said that support for media industry. So we both had a good interview. I made you smile, you made me smile. We should plan more interviews where we make everybody smile.
Thank you.